Hello and welcome to the Wealth Legacy Blueprint Podcast with your hosts, Richard and Andrew Hanson. I'm your producer, RJ Malik. Andrew and Richard, you have an interesting topic. We were doing a little discussion before we turned the mic on, and I'm really, really interested to see what you guys are going to lay out today. So, Andrew, why don't you take it away?
Yeah, absolutely. Thanks, RJ. Yeah, I mean, given today's time and election years, and we thought what better time to bring the country together and bring the families together than bring up politics, because that's always the best thing to talk about at the dinner table. So let's just do that today. But realistically, I've been getting phone calls almost every day from clients asking me what's going to happen during the election. Rich can attest to that. I'm sure he's been getting those phone calls too. And I think today is going to kind of shed a little bit of light. We're going to try to stay nonpartisan, because I've learned my lesson to stay as nonpartisan as possible and just really shed light on historically what the S&P 500 has done in the past and kind of what we can expect going forward, and just really sticking with our plan going forward during these volatile times. So first, we're just going to go over some facts. There's no bias here. It's just all facts. All right. So if we look at the average annual S&P 500 performance over 1933 to 2022, if we look at the Republican presidents with a Democratic Congress, the average annual return has been 4.9. With a divided Congress with a Republican president, the average return has been 13.7. Now, if you have a full Republican Congress and a Republican president, the average was 12.9. Now let's look at the Democratic president. If there was a Democratic president, the average S&P 500 annual performance with a Democratic Congress was 9%. With a divided House with a Democratic president, it was 13.6. And then with a Republican House and a Democratic president, it was 13% average annual performance of the S&P 500. So this is kind of, when we get these phone calls from people, they go, oh, well, what if this person wins? Everything is going to go to hell in a handbasket. Or if the other person wins, everything's going to hell in a handbasket. Overall, we can look at the data and really reaffirm what we're thinking is that's not always going to be the case. And here we're going to take a look at the election years. This is going all the way back from 1928 to 1972. You can see FDR had a 43.3% back in 1928, the good old days. It was almost 100 years ago. You can see it's up and down throughout every other year. Given the presidency, it doesn't matter. You can see Democrat, Republican. You got Lyndon B. Johnson. You got JFK. You got Nixon up there. In 1972, it was an 18.9% return in an election year. We got Jimmy Carter in 1976. During his election year, it's 23.7. Richard Nixon in 1980, 32.3. Mr. George Bush Sr., 16.6% in 1988. Bill Clinton in 1996, his election year, it was 23% return. In 2008, I think we all remember that great and wonderful time. There was a housing crisis. With Barack Obama, that was minus 37%. And then you're seeing an average around 10 to 15% from Obama's second term to Trump all the way up to Biden. We try to kind of look at the facts because we look at the headlines and we know there's so many different sort of attention-grabbing headlines that say, we're going to war, we're all losing our money. So we like to look at the facts and look at historical performance, and that really grounds us in reality. Rich, I kind of want to ask you a question. If somebody is concerned with the market and what it's going to do in the future, what is some kind of general understanding or general advice for them going forward on how they could adjust their investments?
Well, thanks, Drew. And I think as you look at those election years, you can see more times than not, we've always we've been on the upside in the red, except for the housing crisis in 2008. I go back to what we've been doing for 43 plus years. And those 43 years simply is to identify what your concerns are, what your risk tolerance is, and devise a plan that not only includes some S&P 500, some NASDAQ, some Dow positions, based upon what that risk tolerance is. But included with that are some fixed instruments that provide some liquidity, some CDs at banks, maybe some positions in what we call fixed indexed annuities. But diversify yourself. For the younger folks, it may make sense if you're in your 25s to 30s because typically you have longer time to recover any potential losses. But I think this all goes back to what we've been preaching is diversification. Stay the course. If it works today, whether we have a Democratic president, a Republican president, Democratic Congress, Republican Congress, I think it all comes down to sticking with your plan. One of the things that we're doing with folks now that are coming in new with us during this period of time, I would be very hesitant to take a chunk of money. And whatever that amount is, it's important to other people. But if it's 20,000, 50, 100, 500, or $1 million, we're not putting that right into our portfolios. Again, into those indexes, because things can happen during this period of time that could derail our long-term goals. So for the next 90 days, 120 days leading up and beyond the election, we do dollar cost averaging. So if someone gave me $100,000, we would identify risk tolerance and what your needs are and put that money into a money market account. And on a monthly basis or bi-monthly basis, take a portion of that and invest it into the number of different areas that I talked about. Maybe it might be CDs, NASDAQ, S&P, or Dow indexes, fixed indexed annuities, those type things, where we're not triggered by a one-day turnover. We had some very dramatic turnovers going back 2 weeks ago that were frightening for a lot of people, which led to a lot of discussions. So dollar cost averaging, knowing your customer, knowing your risk tolerance, knowing how far you are from retirement, knowing your tax bracket, knowing your income needs and your expenses needs, I think overshadow the numbers that we're looking at. These numbers are important, but we can't plan our retirement on a small segment. Remember, if we live well, we've got 25 to 30 years in retirement, and to zero it in a 1 year period is dangerous. But caution, and that caution simply is look at dollar cost averaging. Anyone who's investing now and simply putting money into the markets is being speculative, in my opinion. You're more prudent to do that dollar cost averaging and to determine, again, I keep saying it over and over, risk tolerance and the length of time you have before you are retired, or even if you're retired now. So a whole lot of different things, but all important. But this small segment in the world we're in now shouldn't change your overall adaptation to the markets.
Yeah, because when we talk about, who's going to win, what should I do? Should I move it into this position? It's all speculative. It's like buying a stock. Well, I heard that a certain company is, investing in a certain demographic or technology. So I'm going to jump on them. That's very volatile. So, what we want to preach is always consistency. And you brought up dollar cost averaging. I think that's great. We've been doing a lot with that, coming up to the election. Yeah, we can kind of prepare for volatility, but we don't want to necessarily jump all our eggs in one basket or jump in head first. We want to sort of prepare for what the market, throws at it. And we're always like that, regardless of election year. But Rich spoke to it well. So that short-term thinking is not going to provide long-term success. If we're prepared for a 1 year section, you're not prepared for 30 years.
It seems to me, if you don't mind me just jumping in for a second, just looking at the chart that you had shown us, history, if you should really study your history, because history shows that, there's going to be leaps here and there. But overall, to me, my observation, not that I'm trained or anything, but to my common eye, it looked like there were more ups than downs. So if you're patient, that's going to pay off.
Amen. Correct. And The interesting thing is when we do our research, which is a daily, hourly, minutely research on where the markets are and how they affect different segments. We're utilizing our sources, and those companies: Morgan Stanley, Wall Street Journal, Goldman Sachs, U.S. Bank, Fidelity, T. Rowe Price. A lot of big people that know a lot of stuff that's going on, and they're preaching the same thing I think that we're preaching. It's important you understand the volatility issues because, quite frankly, the news media is the ones that spread that doubt and that insecurity. And it happens on both sides. One side will say, look at what they've done to inflation. Look what they've done to interest rates. Look what they've done to this. And the other side will say the same thing back and forth. So it's in the limelight. People listen. And I think the biggest thing folks can do is have the opportunity of working with that shepherd that can walk you through those anxieties and affirm that the game plan that you've established, in fact, is part and parcel to this. I had a call from one of my long-term clients when the markets had 4 or 5 or 6 or 7 days, real bad volatility, and he was concerned. And I said, hey, Jim, nothing's changed. You're still in retirement. For us to try to outsmart this market, I mean, I'm a smart guy and I've been doing this a long time, but I tell you what, if I knew what the market was doing, you wouldn't be seeing me. I'd be on an island somewhere sipping a drink with an umbrella and a bunch of cherries in it because I know the market. So if we believe that our initial assessments, assumptions, assertions are in fact valid, they can withstand volatility. If you've got things that are going up, you've got things that are staying down and things that are staying flat, again, based upon your risk tolerance. So, this is something we're hearing an awful lot about. It's important to understand that I think oftentimes it becomes a political tool and it stirs anxiety. But if you've got someone who does the things that we do, that's the person you talk to, and they can set you straight on those anxieties.
Yeah. And I think it's important to note that, when we get together with a client, not to say that we're prepared for this type of election and this type of political environment, because we've never seen anything like it, but we're prepared for volatility. We're prepared for the long term. We know we've seen it. We've seen market downturn. We've seen market uptick. So we're prepared for pretty much anything that the market throws at us. And we just want to continue to stay on that plan. And I think one of the books I want to bring up, it's called The Behavior Gap by Carl Richards. And Richard had a chance to speak with him and listen to him talk in Tennessee. And his big thing, and it really kind of affirms what our goal is just stick with the plan. We plan for market downfalls. We plan for market upticks. So we can't constantly be changing our strategy based on the market, because now you're giving all that power and you're letting the market decide how you want to retire and how much money you want to make. At the end of the day, it's about you controlling your retirement and your assets, and how we react to the market. It can't be based on short-term concerns or anxieties. So that's just something that we always want to preach, and just stick with the game plan and just keep doing what you're doing. Get confirmation from Richard and I. We'll talk you off a ledge, and we just got to look at the facts and just keep going forward.
One last thing for those that like to gamble. If you look at the last second term, it was going to be Mr. Biden, but it's now Miss Harris, that Bill Clinton in 1992, the S&P was 7.7. The following period, 1996, it went to 23.1. 2008, S&P 500 was down 37%. Now, we know that wasn't the president's problem at that time. It was the residential crisis we had. but the next year was up 16%. Currently, with our current president, we're up 17.9% of the S&P. So if you're a gambler and you believe the Democrats will win, take all your money and put it into the S&P 500, because if history repeats itself, and I'm doing this all tongue-in-cheek, there should be a significant increase with that second term party. So, I mean, there are some compelling numbers. We can get numbers from anything, but as Drew said, it's as important as ever to be consistent, to be focused, and to have an open dialogue with that person who's helping shepherd you through these most difficult times. And we pride ourselves in that, to spend the time with those folks who do have those insecurities.
So it seems to me really the important thing is to put a game plan in place. So you're set to go, because it is going to be a little bit rocky from time to time, and just know that that game plan is ready to go. So, and then occasionally review it, obviously, but for the most part, it's the initial game plan that it's really important. Am I understanding that correctly, or am I off? Tell me if I'm off.
No, 100%, 100%. And that's what we take a look at. We tell folks when we begin our journey together, and we give them the opportunity to do a lot of interviewing on who we are, what we do, and how we can help them. But once that journey starts, we call it a blueprint, a game plan, a roadmap. You're never going to take a trip from California to New York and not Google map or figure out where you're going to stay, how you're going to stop. And more often, people during retirement or getting close to retirement, they don't look at maps. They don't look at blueprints. They don't look at, how do I get from here to there? Well, that's what we provide. And it's real important to determine all those things that I talked about. What's your income? What's your expenses? What's your Social Security? What's your tax brackets? What's your wishes and goals for when you're no longer here? Your risk tolerance, all of those issues. And we meet with a client, we tell them every single time when we join forces. The first year we meet every quarter. The second year and beyond, we meet twice a year to go over, because we may have indicated inflation was going to be 3%, and oh, whoopsie, now it's 7.9. Or we believed we could get a 7% return. Oopsie, it's 2. Or oopsie, it's 14. We need to adjust. And if you're consistently part of that team, and we call everyone we work with team members, stolen a little bit from Disney, maybe they won't charge me for it, but everyone is a team. And I just happen to be maybe the head coach, Drew's co-head coach. And ultimately, the people we work with, they're owners. We're showing them what we're going to do for this team and how it's going to work. And they're the ones that are going to buy into that game plan or not. So great question, RJ. It's real critical that not only do you identify concerns and all the other variable things involved, but it's really important to make sure that we're in touch with folks on a regular basis. And I do, when we meet with them twice a year, it's a good hour, and we go over everything tooth and nail. And really, after about the third year, they go, quit calling. So, but anyway, yeah.
It's easy to be paralyzed by fear. And so when you start to see volatility or unwavering in the market, it's easy to want to pull out and just run for the hills and take your money. But vice versa, it's also easy. It's just in our DNA. You know, if we were cavemen, we saw a mammoth coming towards us, we'd run the other way. We don't have mammoths anymore, but now we have stock market downturn, which is kind of the same thing. You start to see the market kind of take a dip, and you're like, get my money, get it out of here. So we never want to shame somebody for feeling that way, because it's part of the human DNA. So it's something that we try to instill with our clients is you just got to keep staying with the ways, reaffirm our game plan. We'll come back, a couple months from now, and we'll see how it's going. If we need to adjust certain things, perfect. But we're not taking the game plan and we're not throwing it out the window. There's going to be wins. There's going to be losses. When the markets, a lot of people, a common mistake, which I've read a lot in The Behavior Gap by Carl Richards. Common mistake also as well, when you see the market go up, oh, I need to throw everything in the stock market. Like Nvidia recently, that stock just short, and I have soared. I have people calling me nonstop. Should I put money in Nvidia? Should I, do this in this stock? It's gone up 20, 30%. It's like, if you've heard about it, it's already too late. It's going to hit the mountain. Once you're at the top, it's, we could see something like we saw with GameStop. It just keeps climbing, but realistically, it's going to have to correct at some point. So we have to kind of reaffirm our prospective clients and mostly my friends who want to invest in stock. It's our natural reaction to, when you see something good, I want to go, join that. And it's by that time it's already too late. So it's not uncommon. It's very common for people to kind of want to do twitch reaction and investing. But at the end of the day, we plan for this. We plan for 30 plus years, depending on your age and your goal. We plan for this. We're not short-term planners. We're long-term planners. And so you got to constantly kind of reaffirm, be prepared, take in the facts, learn your history, and just keep your nose to the grindstone. I know it's, coach speak, but that's really kind of what we got to preach. And just find confidence with your advisor or anybody who handles the finances. It's just, at the end of the phone call, we want to instill confidence that you have got this. You've got this going forward.
So knee-jerk reactions seem to work against a person if they, like you said, if they're seeing it in the news, it's over. And you really should just, again, trust the game plan.
And the thing is, a lot of people, they say, buy low, sell high. Well, guess what? When those stock markets go up, or when that stock price goes up of a certain stock, the people who have those stocks are betting on you buying those because they bought it low. Now they're going to sell it high. So now you're essentially getting in when it's at its highest. You're doing the complete opposite. You're buying high. Eventually, you're probably going to have to sell low. And Rich can kind of attest to this. We're not saying don't invest in stocks, but just be aware. If it fits with your financial plan, then it'll fit with your financial plan. But again, it's just back to it. You don't want to have any knee-jerk reactions.
Yeah. And you said one last thing, if it fits into your financial plan. I'm 68 years old. I don't own individual stocks. Now, does that mean I don't trust them? It doesn't mean anything other than I don't like volatility at my age. If I'm lucky enough to be around 10, 12, 14 years from now, I don't have the time to recover those losses. So there isn't a stock portfolio. Now, there's a mutual fund portfolio that contains stocks of any one of the three indexes we talked about, but it shifts the risk from owning one stock to owning 500 different shares of stocks. But I'm very low on our risk tolerance scale, 1 to 5, 1 conservative, 5 aggressive. My wife and I are about a 1.5, and that's fine because my ultimate goal is to not worry about life and continue doing the things that we do now and pass on those assets, those benefits, those love taps to my children and my grandchildren. And so that's why there's no stock in my portfolio. If someone comes to me and says, hey, we want to do some stocks, I'm going to refer them to my stock traders that I work with because I'm just not in it on an everyday basis now. We're into the overall planning area, and so it's not individual stocks. But again, it goes back to what you said earlier, RJ. It's whatever game plan we set in motion with little tweaks. Significant things happen in the market like 9/11. That caused some tweaks. Hopefully we never see anything like that again. But if that happens, we still maybe don't stand steadfast. We may move out of some positions into safe harbors like money market accounts until that situation has gone away. But given day-to-day things without any historical negative consequences, we certainly will stay the course and shepherd those people all the way through.
So here we're going to look at the year of the presidential term. So in the first year, 57% have been positive returns. 43% in the first year have been negative returns. Second year of a presidential term, 65% have been positive returns. 35% of the years have been negative returns. And then the third year of the presidential term, 91% have been positive returns, and 9% of those years, negative returns. In the final year of a presidential term, there have been 82% positive return years and 18% negative return years. So if we look back at those presidential years and election years, you see our favorite Jimmy Carter, George Bush, Bill Clinton, little George Bush, Donald Trump, and Biden and Obama. So this is where we're going to separate a lot of people, and I'm trying not to be bipartisan. So if you're taking it that way, I severely apologize, but this is all numbers. Political party of the presidential electee, Democrat, average returns in an election year, 7.6. The average returns of a presidential electee for Republican Party has been 15.3. The overall average, 11.28. So this, again, we're just speaking to kind of our concept and our planning. It's all long term. You're going to see ups and downs. Again, we're not saying it's going to be all positive, but we plan for this long term. It's not a short term game plan. It's a long term goal and game plan going forward.
A tough part of your job is keeping people calm when things are a little rough, and trying to make sure that they don't overreact.
Yeah, I mean, I have a lot of practice because I have 2 boys at home. So it's, you practice with that. You try to keep them from overreacting. No, I mean, Rich, I'll let you kind of answer this as well. But, when we have the facts and the knowledge, and Rich has been doing this for 40 plus years, so he's seen it all. So he's got the facts and he's got the data, and he's come out on top. So he can reaffirm any, anxiety that a client may have. Rich, can you kind of speak to that a little bit?
Yeah, and like I said earlier, myself, scale of 1 to 5, 1 conservative, 5 aggressive. I'm a 1.5, and that's defined by my age and my goals for what I want to do with whatever baskets of money I have later on down the road. Most of our folks, again, if you go back, I started 43 years ago. That means I was 25. At the time, I'm probably working with 35-year-olds, 40-year-olds. So those people are now 80 years old, 75 years old, and their portfolios have changed dramatically from that 35 all the way up to 80 now. And their goal is to have the rest of my life money, have money to protect me in case I have long-term care issues. And so you see that pinnacle of risk tolerance going up or going down. And it's important to identify that and understand it. And most of those older folks now, we're in a position where we have less mutual fund holdings and more investments into some of the things we'll be talking in future podcasts, fixed indexed annuities, which provide principal protection, but upside potential within the market using one of 10 different indexes. And there's a minimal fee attached to it. But my folks, when the markets go up, they're real happy. My folks, when the markets go down because of the positionings with these fixed index products, they're just as happy because they've not lost money. So again, it comes down to what we've been preaching, that you've got to be there for people. And I'm very proud to say with Drew, with our staff, and part and parcel with me, we're there for those people, and we can identify which ones are the ones that need that. When I was coaching back in the day, high school, you knew the kids that you could yell at a little bit. You knew the kids that if you yelled at them, you've lost them. The ones you could pat on the butts, the ones that you can tap on the helmet. So each and every person's different, but I know my people that need different attention. And when things go crazy, they're getting a quick phone call from me. I'm not going to text. I'm not going to email. I'm going to get right to them and say, hey, Jimmy, hey, John, hey, Bobby, things are going well. Here's what we're looking at. And they understand. They just want that pat on the back. And I am blessed to have a staff that has bought into that theory to treat all our customers like that. And there are ones you have to treat a little bit differently, and everybody understands it. So.
All right. Very good. Anything else, or do you want to wrap it up and give out some contact information?
So basically, at the end of this, we want to stick to kind of three main talking points. Is we want to stay informed but rational. We understand it's essential to stay informed, but we also want to be grounded and rational in our investment strategies. Diversify. Really, diversification helps mitigate any market volatility. And really, we hammered this earlier, long-term perspective. We're not planning for short-term, we're planning for a long-term goal. So you always want to keep that in mind. Reaffirm your initial game plan. So stay tuned. We're going to keep doing these more and more often. We're going to try to stay as current on updating topics. Election year, I had to get this podcast. I called Rich. I said, let's do this. And it's hot. We got to strike while the iron's hot. So stay tuned. You can visit us, www.generationswealthmgt.com, where you can find our YouTube and our Spotify, as well as the podcast Apple app. Again, thank you so much for stopping by, and we'll see you guys around.
Andrew and Richard, thank you so much. It was just really informative, lots of good stuff there, and we're looking forward to your next podcast. And thank you for listening to today's Wealth Legacy Blueprint podcast. Please like, follow, and share this podcast with friends and family. Until next time, for Andrew and Richard, I'm RJ Malik.
That's a wrap on today's episode of the Wealth Legacy Blueprint. Don't be a stranger. Hit that follow button to stay connected. Got questions? Need some personal finance tips? We're just a click away at www.generationswealthmgt.com, or give us a ring at 1-833-948-2466. Remember, it's about more than money. It's about your journey to financial freedom. Stick with us for more real talk and real strategies to make your financial dreams come true. Opinions expressed here are our own and our guests, not necessarily those of Generations Wealth Management Group. This podcast is all about education and not direct financial advice. For the nitty-gritty on your own financial situation, always chat with a professional.